morning, and thank you for joining me today to talk about the Federal Market Open Committee this morning, their meeting for July, which they ran through their views around the economy and thinking about the path for policy rates as well. My name is Kerry Craig. I'm a global market strategist here at JP Morgan, and we'll be talking about what the Fed means for us in terms of how we think about asset allocation and potentially what it means for thinking about the direction of the US economy as well. So diving into what we're going to think about today, and obviously the Federal Reserve and what we heard this morning, very much a more dovish message than may have been expected. There was no real surprise in terms of the Fed setting the market up for thinking about a rate cut come in September, their next meeting. But there was a few more tweaks around the statement and the press conference itself, which really did suggest the Fed is also a little bit more concerned with the outlook for the economy than perhaps they had outlined in the past, and thinking more around the balance of risks and the growth outlook, particularly when it comes to that balance between the outlook for inflation and thinking around the outlook for the labour market as well, because it is important to remember that while there has been a huge amount of focus on that inflation outlook and controlling it, the Federal Reserve does have a dual mandate, and that is price stability, 2% inflation growth over time, and also for full employment. And that full employment one has been easier to achieve when the unemployment rate has been so low, but has started to rise a little bit more recently. And we think it's appropriate to think about that balance of risks as well when we're looking at what's happening in the markets more recently with some of the churn and rotation that's happening within equities, and particularly some of the positioning and perhaps imbalance that may have crept into portfolios given the very strong run we've seen in risk assets this year and the continued weakness in some parts of the fixed income market around government bonds, and how to address that when we do think about that balance of risk for the US economy and the economy more broadly. So diving into what we heard this morning and thinking about the Federal Reserve and what they said. Now, it wasn't a quarterly meeting, so we don't get a new set of statement of economic projections and forecasts from the Federal Reserve, but it's important to look back and think about how they thought the economy was tracking their forecasts in June and what we heard today around that. And looking at the tweaks they made to the statement, which are always quite nuanced in terms of the words they choose, but quite deliberate. There were some there that were a bit more subtle and some which were quite overtly direct in terms of how they're thinking about the outlook for the economy. Now, broadly speaking, they do see the economic growth in the US as remaining as solid. That's how they described it. But when it comes to those other parts of the economy, when it comes to thinking about the labour market and the inflation rate, there's a few more tweaks there. You can see that in their table here, they have for the full year for growth for 2024, real GDP at just over 2% for this year. Economy, it has been running at sort of 1.4% the first quarter, a bit stronger in the second quarter at 2.8%, but an inventory rebuild for a large portion of that. But does again suggest the economy is still relatively robust. We would think about it slowing down over time, but we'll come on to that. But broadly in line, the economy is tracking as the Federal Reserve expects it based on their forecast back in June. When we look at these other two numbers, though, if we take the inflation rate here, for example, they look at core PCE, or this one is headline PCE inflation. They thought that it would be about 2.6 for this year. It's currently already sitting at 2.5%. So they're very much on track to reach that inflation target. They're almost within striking distance of achieving it. So it makes sense that they would be thinking about how they could be starting to ease monetary policy, given that their inflation mandate is very much coming into view. And it's also worth recognizing there the unemployment one. This is really where the statement stood out. So why they thought about inflation that was not modestly coming down, but was sort of moving somewhat towards their progression of their inflation target, so slightly firmer language there. They noted that the unemployment rate had changed, while still very low. There had been a bit of a movement upward, and the pace of the employment growth, as they put it, was a bit more moderate and strong. So really bringing back down their views on the labour market there. And again, that's because their full year unemployment forecast here on the table at 4%, unemployment rate in the US is currently sitting at 4.1, and there are risks that it could go a little bit higher. And so that's probably where they're starting to think about more that balance between inflation and growth becoming a little bit more important. In fact, the words that they used were that they were much more attentive to that balance of growth across the jobs market and across the inflation outlook. And they're very much aware of that. And that's very different to what they said in their last statement, where they were just thinking more around the inflation outlook. So the jobs in the labour market has become very much more important than thinking about their read on the economy and that potential weakness that may be starting to skip through. Now, I think that's right, because when we look at the restrictive policy that we've had in place in the US for some time now, it has solely been about getting that inflation back towards its target. That's been the sort of driving force around their decision making, that inflation is too high, it must come down. It's perhaps been driven by that tightness in the labour market and that wage growth that's coming through. But as that inflation is coming back towards their target, as we have a headline inflation rate at 3% or a PCE number at 2.5%, and that continued moderation in inflation over time, they're slowly remembering they do have that dual mandate. They're looking at the fact that you have seen that move higher in the unemployment rate. And so that decision-making becomes a little more balanced around the two of those factors, and also means that that sort of restrictive policy starts to err back towards something that's looking more neutral over time as they start to see that come through. And that's really what we want to see. We want to think about a Federal Reserve that's proactive when it comes to that policy setting and not reactive. We don't want to be a case where, again, there's a policy that's been held too high for too long or too tight for too long, and the Fed gets caught behind the curve again when it comes to easing policy. Perhaps, as some may argue, they were caught behind the curve when it came to tightening policy as well, and then you get that policy error creeping in, and the economy suffers as a consequence of that. So it's a positive sign they're thinking about more of this balance in the economy, that they're thinking more around the risks to the downside as well as to the upside in terms of that policy setting. And that very much did really set the case for thinking about that easing in September, even though Chair Powell wouldn't be drawn into really what that meant beyond September in terms of the pace of the rate cuts or thinking about how that may change. However, I would sort of argue that, the focus will be on the labour market. So any sort of more detrimental or more negative outcomes in the labour market would raise that prospect of perhaps seeing a faster path of policy easing. But we'll come on to that in a minute. So when it comes to our views on the US economy, it is looking relatively robust. Things have been going fairly well, but we are very much aware of that slowing in momentum that is coming through, and very much an economy that is moving back towards that trend-like pace. And I think when it comes to the inflation side of things, the way the Federal Reserve is characterising it and the way that we've been characterising it is that driving force on inflation is becoming more narrow over time. So the number of categories that we see is driving that inflation number above target is slowly starting to come through. Now, we are thinking about the fact that energy price inflation really is starting to fade off, as you've seen in the left-hand side of this chart, which just breaks down the inflation numbers by the different categories in terms of contributors. We know that services inflation is also coming down a little bit outside of some factors, but goods inflation has also been very much not adding to that growth outlook. And we also have the shelter component starting to come down. Now, shelter is an interesting one because there's many forward-looking indicators for shelter, which is calculated in a rather abstract way in the CPI basket. We can look at the rent price increases for new rents. We can look at existing rents for leases that are being rolled over. All this tells us that the pace of inflation in these categories should start to come down. And that shelter component is one that does have a lot of cyclicality behind it. It tends to move in these very slow, long-run cycles, but it's very much momentum-driven. So when that momentum is on the way up, as we've been experiencing, continues to do that. But when it turns and starts to move downwards, that momentum will also be behind it when we have that slow sort of easing of that shelter pressure coming through the inflation basket. Outside of that, when we think about those other forces that have been driving that inflation number, again, more on the super core side of inflation. So this is the services part of the inflation basket, excluding shelter, which we break down on the right-hand side there. You can see there's a big red component around this transport services. So auto insurance largely that's driving that. And again, there's well-known reasons for why this has happened, given some of the impacts of used car prices and car prices through the pandemic, that they've been running at an increase which just isn't sustainable in terms of that double-digit growth over time. And so we would continue to expect these numbers start to fade off, again, alleviating that pressure within the inflation basket, seeing that number, whether it's the PCE or the headline inflation number, continue to moderate over time and very much moving towards the Federal Reserve's target. And it was interesting to note some of the comments from Jerome Powell at the press conference around the labour market when it came to the inflationary pressures. So the tightness we've had in the labour market, that wage growth that had been moving higher, that had been a reason to see that pass through to services, inflation through wages come through. But now we have that balance coming back into the labour market. The Federal Reserve was less focused on that wage pressure as a driver of inflation and thinking about that not really contributing so much in the future. So really a change in tack there from the tightness in the labour market to that balance and what that means from the pass-through from inflation. So again, the assessment of the labour market more be around the downside risk to growth rather than thinking about the inflationary consequences of that move higher in wages, which we have seen starting to come down over time. And that does bring me to the jobs market. So this is kind of the pivotal change that we've seen in the Federal Reserve at this meeting and thinking about what they've been talking about in the past. I guess their concern really does come into the fact that they're probably looking at this chart on the left and looking at the unemployment rate over time, just as we do, and have noticed this very distinct trend. The grey line on the left shows you the unemployment rate, and that it slowly sort of eases its way down. It creeps down over time, and then it usually goes up very quickly when it does start to rise. Here we've showed these recessionary bars. So usually there's a downturn in the economy that causes that, and you actually see that unemployment rate jump. And so we've been through this period where the unemployment rate has been a little bit different this time, given the pandemic and what it did to the labour market. But we've seen it come down pretty quickly, and we're starting to see it creep higher. Again, the Federal Reserve may be concerned that we don't get that slow move higher in the unemployment rate, that actually it does jump up more meaningfully, and that we sort of revert to this trend that we've seen in the past of a big move up in the unemployment rate if we do see a sharper downturn in the economy. Now, certainly, again, you can see the wage growth there has come off a lot. We look at that purple line as well, feeding into that idea about wage pressures easing up in terms of that inflationary basket. But we do think that the movement we've seen in the unemployment rate since the cyclical low of 3.4% now to 4.1% against their expectations for that 4% unemployment rate will be really grabbing the Fed's attention when it comes to thinking about the direction of the economy and the fact that you have seen a lot of consumer support for growth over time and how that could change if the job market suddenly does start to come a little bit weaker. Now, the balance that the Federal Reserve and Jerome Powell has talked about when he thinks about the labour market really does refer a lot to the chart on the right-hand side of the page. Now, this one's not actually in the Guide to the Markets for Asia, but it's a very similar chart. It shows you the ratio of vacancies to unemployed. So really looking at the number of job openings from the JOLTS report to the number of unemployed people that are in the economy at any given time. You can see how that ratio really shot up during the pandemic. Obviously, we had a vast number of job openings that were there. We were thinking about a very low number of unemployed people, either because there just wasn't enough supply of labour coming through or because there was ample job demand to come through. So you had that big imbalance between demand and supply in the economy. And as we've had the benefit of the positive net migration in the US, which has eased a lot of those supply side concerns around the labour market, as we've seen some of that slowing in the economy and perhaps some of that creative destruction when it comes to thinking about companies that were perhaps open during the fiscal expansion we got during the pandemic, which have had to close, and you've seen that come off. You have to have that balance now come back in, and that purple average line just shows you we're back at where we were in 2019. So that balance really is coming back into the labour market. Now, there still is a high number of job openings relative to prior to the pandemic, so there is still a good source of demand there. We do have better supply coming through, and this does alleviate some of our concerns around why we may not see an immediate rise in the unemployment rate. We do think the economy chugging along does create that. But we are looking at this more closely in terms of how much the unemployment rate could rise. But we're going to get another labour market report on Friday evening for Asia in terms of the non-farm payrolls that comes out. We are expecting a relatively softer number of jobs being added compared to the last month. So that moderation in the pace of job gains coming through. There have been some statistical anomalies, a lot of the jobs numbers coming out of the US at the moment, given the two different labour market surveys that are done. So we have the household survey and the establishment survey, and they haven't always corroborated. So there is a chance we actually do see, a softer non-farm payrolls, but also an unemployment rate that does tick back down to 4%. So this can be somewhat confusing for market participants and looking for the read-through, but we would tend to look at the underlying and say that is still a softening in the job market. Similarly, with the JOLTS numbers that came out, we saw the job openings come down, but a little bit less than expected. But we also saw a quits rate that came off as well, and layoffs that also sort of crept higher, indicating that people aren't really moving jobs as much. They're not voluntarily quitting their jobs to move to other ones, suggesting that they're pretty happy to stay where they are and think about the prospects for moving for higher wages not being as enticing as in the past as it was, or thinking about the prospects for getting that new job may not be as strong as they were in the moment. Again, indicating there is that softness in the underlying employment data starting to come through. And again, that being a reflection of where the economy has been, given that as a lagging indicator for growth in the economy. Now, there is another view here in terms of the labour market around thinking about what it actually means for the broader policy narrative. And as I mentioned, I think that the focus here will really be if we see a more sustained downturn, that may spur the Federal Reserve to be a little bit more reactive when it comes to setting policy. And that's where you can start to creep in and think about, those policy easing being either more quicker in terms of the cadence of that policy, or thinking about them being larger in terms of the size of the move at those meetings. Now, for us, we are thinking about largely what's reflected in the market. We do see 2 rate cuts this year from the Federal Reserve, so September and then in December, and then following that quarterly cadence through 2025, so 1 at each meeting, likely corresponding to when they release their set of economic forecasts. Now, Jerome Powell did push back on the idea that you could see a larger than 25 basis points move in September. That wasn't really discussed, but again, that'll be the indication if you saw a weaker number on the jobs more significantly over the coming months, that suggests that they may have to step up their policy easing or perhaps increase that cadence. Now, again, it's worth noting that looking at the market pricing, the market's now looking for more than 2 rate cuts this year. If you look at the number of basis points being priced in, and looking for more than 4 rate cuts being priced in for next year, so around about 110 basis points of easing. So there is scope for the market to have gone a little bit too far here, and I think that's important when we start to think about the asset allocation decisions, particularly when it comes to the government bond market, which I'll come on to. So the focus very much is going to be on the market for the unemployment rate and thinking about how that changes things. I think in broad terms, we look about where we are with the US economy. It is looking at something that is more focused on, it's very much a soft landing that is materializing. We have inflation that is coming down. We have growth that is sort of posting trend-like numbers and expected to be a little bit softer, but continuing along around that 2% growth. And then that is actually quite a positive environment to think about allocating towards risk assets, whether it's across equities or credit, but being mindful of that balance around the risks and the downside that is perhaps presenting itself a little bit more and more over time. Now, what are those downside risks? It really comes back down to the consumer in large part. So what we have seen is a consumer that's been remarkably resilient, continue to spend even in the best of times and in the worst of times, largely because they have had the support, firstly, from the fiscal side of things that came through the pandemic and the transfers of wealth from the government to households in terms of supporting that spending. They've managed to run down the savings rate. If we look at the breakdown of the national accounts in the US, so I continue to say that they've been spending more than they've been saving over time. They have had that benefit of the tightness in the labour market and that wage growth that has been moving higher, so creating that positive real wage growth in the last few months that supported that spending habit. But also, and somewhat of a negative connotation, we've seen credit cards and the total amounts extending on those start to run up back to their prior pandemic levels, in fact, to new record levels as well. So there has been that credit-fueled spending in the economy as well. And that's where we start to get a little bit more concerned around the impact of higher rates. We've seen those delinquencies on credit cards start to tick up. We've seen those delinquencies on autos start to tick up. And if there was a case for a more moderating outlook, some of that provision of credit might start to be taken away, and we could see those delinquencies start to rise. And that's really where you start to think about the cracks that come through on the consumer side of things that could present a bit more of a downside case to the growth outlook. And you can, again, extend that to certainly what we've seen perhaps in some small companies in the US as well. There is a big question around what the fiscal side did during the pandemic in terms of perhaps creating those longer lags for monetary policy. So the fact that, many companies have got offered support by the government, maybe kept them going longer than they should have been. And now that that fiscal support has been removed, They're starting to close those stores. They're thinking about the fact that that might be adding to the unemployment rate, the fall in those job openings, and that could continue for a little while longer as you even think about the benefits of those lower rates being a little bit too late to come through to support these companies. And so you do get that downside coming through as that lag has been maybe a little bit elongated compared to historical ones that we have seen come through. And certainly that may be a little bit more the case when it comes to things like private lending in the economy and the growth in the private credit market. Again, there things become a little bit more opaque because of the data that was there. But it's always one of the risks that, that private lending doesn't allow for these companies to be naturally go bankrupt because they don't want to accept the loans, so they do more extensions to keep them going. But they're not just really viable companies in the near term, and so that destruction comes later in terms of those companies going bankrupt and the economic consequences of these. So these are some of the downside risks that may be presenting themselves. They're not our base case, but things that we look at, and perhaps things that could actually still creep through to bring that outlook to be a little bit more benign. Now, there are upside risks to the economy as well. The first is that consumer that does continue to spend, and that consumption is a bit of a strong case for the US economy in terms of its contribution. So the consumer could continue to spend in this environment. It will have, again, that positive real wage growth supporting it. It does have still a relatively low unemployment rate and relatively balanced labour market, which is supportive for that. And we've also seen a huge amount of spending on the corporate side, whether it's AI or AI related things, and perhaps some of, again, the lagged impact of those big policy measures around the IRA or the infrastructure build out still feeding into the economy. And so those could be, present somewhat upside risk to the growth outlook as well. So while our base case is the soft landing, I think it's important to be recognizing that there are somewhat both downside and upside risks to the growth outlook. Things do seem to be a little bit more biased to the downside at the moment. We're looking at the data coming through in the softness. But by and large, we think this is an economy that's going to continue to move forward at that 2% growth rate. And that does present a pretty positive outlook when we're thinking about how to allocate across markets and how to think about equities and fixed income in this environment. And finally, I just mentioned it's not just the US. Obviously, we're thinking about a more synchronized easing cycle across central banks around the world, not everywhere. But this is very different to thinking about a coordinated easing cycle. Every central bank is very much focused on their domestic conditions and setting policy for those conditions. But we are thinking about the ECB that has already cut rates and likely to move again in September when it does meet in line with the Federal Reserve. The Bank of England have had some quite dovish messages more recently, and they're meeting overnight with their cut rates. A little bit more balanced at the moment, given the economic data has been a little bit stronger than expected, and that services inflation a little bit stickier. We do think it'll be a split decision when it comes to a rate cut, but we are seeing them progressing towards that rate cut because there is that disinflationary impulse still in the economy. And even here in Australia, the softer than expected inflation numbers this week have really painted a picture where we get an RBA that is on hold, but certainly the next move in policy rates is likely to be lower rather than higher. But again, not everywhere in the world. We can contrast that with the Bank of Japan, who moved rates again to 0.25%, and is sending some pretty hawkish signals around further rate hikes this year and further progress in that quantitative tightening that's going to come through in terms of that balance sheet. But that outlook for easing policy rates, again, supporting that growth outlook, those proactive rather than reactive central bank policies are quite supportive for the outlook for asset allocation, and one where we would lean more in towards thinking about the equities and the still positive momentum we're seeing in the markets, and also thinking about the fact that even in the US, the earnings season at the moment is delivering on those earnings. We're tracking about 9.5% earnings growth year on year when it comes to the pro forma earnings numbers, and we're seeing margins that are still being relatively supported, which I think is quite important. There have been some concerns around the revenues in terms of the softness and the growth outlook over the last couple of quarters, but US companies are still managing to maintain those margins at just under 12%, very similar to the last quarter. Even if those revenues and those earnings have been a little bit softer on the surprise side than they would have been on average. And you have 8 of the last out of 11 sectors actually in positive territory as well. So we do very much focus on that broadening out in the US of the market in terms of the support, so that move away from the main cap names into some of the other sectors that are doing very well. Now, that could be because they're associated with the theme of AI. So some of the movement in utilities, for example, to support the build out of data centers and energy to support that. or it could be some of the industrial side of things as well, which would fit into that theme, as well as just thinking about an economy that continues to move. Where we'd be more cautious is not thinking about a broadening out, but thinking about a rotation, which we would say in a very nuanced way are different things. Now, a rotation really suggests that you get one sector being penalised at the expense of another, whereas a broadening out just continues to see sectors continuing to improve, but the pace of that improvement is slightly different across different sectors. Now, that rotation, obviously most prevalent when we think about that bias between large cap and small caps. This has not been a new phenomenon. We've seen this December of last year. We saw a very sharp rotation initially when the market started to focus on that rate cut policy for 2024, and there was expectations of 6 or 7 rate cuts. That was relatively shortly lived and came back in. Now we're seeing something that's maybe being a little bit more persistent, but we have those concerns around if the economy does get weaker, that's not the place you want to be in terms of thinking about those small caps. Yes, they should benefit from lower interest rates as they tend to have a higher proportion of floating rate debt than the large cap companies, but we're talking about a very gradual pace of policy easing in terms of historical terms if we do get 6 rate cuts over the next 18 months in the US. And so it's not necessarily going to be a huge change in terms of what we're actually seeing, and it does feel largely marginal rather than something that's going to be very supportive. And we're also very aware that if you look across an index like the Russell 2000, 44% of the companies just aren't profitable. And so we do want to bias more towards the quality in some of the larger and mid-cap part of the market. We're thinking about cash flows and earnings that can be much more supportive in this environment. We do have some of these concerns around the outlook for growth. When it comes to other parts of the risk spectrum we're allocating, again, we're still focused on credit. We very much like the carry that's coming through. We do think that soft landing is relatively benign. It doesn't mean we see a big event in the credit cycle that would see a large number of defaults start to come through. And we're very happy to pick up the sort of 7.7% yield you're currently getting on the high yield market at the moment, which is very attractive relative to the sort of 4% yield you get on a US Treasury. Even in investment grade, where the yields are closer to 5.5%, we think that backdrop of relatively benign economy, that sort of still supportive earnings growth coming through, and thinking about those low levels of defaults really does support that idea that carry and income will be very important in the portfolio at this point in the cycle. Now, fixed income in terms of government bonds, that has been more challenging throughout this year, given what we've seen in the movement in yields. And we do think about the need to not only think about rebalancing that's happening in the economy or rebalancing that's happening in parts of the equity market, but rebalancing that's happening in portfolios as well. And I think the risk for investors here is that the market does the rebalancing for them, but not necessarily in the way they want if they don't do it actively themselves. And so when we think about inflation coming down, that's been the big bugbear when it comes to the outlook for yields. As that's come off, if there's a bit more growth concerns, it does suggest that the profile for yields is a little bit more asymmetric to the downside. And so we would be thinking more around how we can fit government bonds into a portfolio to offset some of that risk around the outlook for growth and really providing that ballast to a portfolio. However, that doesn't extend to thinking about a long overweight towards duration at this point. We very much think about sitting around the belly of the curve, so 5 or so years, where you are getting the benefit of having a little bit of an extension in terms of that duration, but not going far enough out where we're worried about the risks should there be a pickup in inflation that is coming back in terms of one of the longer run concerns around some of the fiscal stance you could see in the US, or even the fact that you may not see those yields fall as far if the market does start to focus more on the fiscal outlook for the US economy, whereas we could definitely see the short end of the curve coming down as we think about those rate cuts coming through. So that relatively steeper sort of cash to 5 years, looking more attractive than the sort of flat sort of 5 to 30 year part of the curve is what keeps you looking at that belly of the curve, that how you add fixed income and government bonds to your portfolio. And similarly, if you look around the world, I mean, you could sort of point towards Europe and think about the sort of stronger path for a rate cutting cycle there relative to the US and the attractiveness of that bond market, or even thinking about the Australian market in this context as well. We have still a steep yield curve or relatively steep yield curve and not likely to see a big movement up in yields, more likely to see that movement down, so getting some of that benefit of the capital as well. So there are opportunities around the world for feeding in duration, but again, it's more a case about not taking on a huge amount of it just yet, given some of those concerns. So we do feel that the US 10-year is going to be largely range bound from here. It is just above 4%. It's probably going to hover in the sort of 50 basis point range around that, anywhere from 375 to 425 as some of these uncertainties start to settle and we get more clarity around just how far the Fed is going to go in the upcoming meetings in terms of that rate policy outlook, but also some of those views around what that fiscal position in the US can mean for the longer part of the curve in terms of what the markets sort of think about in terms of being compensated for some of that increasing fiscal risk that may come through, which could limit just how far those yields could fall in a 10-year part of the curve. So it is still a relatively constructive view on risk assets for us here. We are taking some positives away from the dovish nature of the Federal Reserve, but very much being mindful of those balance of risks around the growth outlook and what that actually could mean. I think the focus now very much turns to the statement of economic projections we're going to get from the Federal Reserve come September, the fact that we're going to hear a lot more from Fed speakers over the next month or so, and really just looking at how much they're going to price in that policy easing in their dot plot projections. Now, in the last June number, they only had one rate cut penciled in for this year, but it was very marginal in terms of it only take one or two FOMC members to change their view to really see that being two come through. But I think more importantly, it'll be their outlook for 2025, whether that cadence of 1.25 is kept, or we actually start to see them pencil in more rate cuts for next year, because the market is not really reflecting much more than that 6 rate cuts at the moment. And again, because that's a little bit different to our view, we would also be hesitant around how much duration you want to take into your portfolio. Now, that's largely the main points we wanted to convey today in terms of the FOMC meeting. I thank you very much for your time. If you had further questions, please do follow up with your JP Morgan representative. We'll be doing another call in September, obviously around the Federal Reserve meeting then. We also have a note coming out today around the Bank of Japan as well, and the implications from that, should you have more questions around what the policy outlook is happening there, as well as thinking about the outlook for the Bank of England after they meet tonight. Thank you very much for your time, and enjoy the rest of your day.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only, based on certain assumptions and current market conditions, and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given, and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase & Company and its affiliates worldwide.